Well, that's because it's call sellers. Call sellers leads to delta getting positioned, obviously, from the call sellers. The delta is negative. The dealer's delta is therefore positive. The dealer doesn't want to be positive negative, so basically sells their positive delta, positive gamma, to become delta neutral. So that's why it's negative gamma, because the actual outcome is basically what we call gamma scalping at highs. Gamma scalping at highs, and obviously that means that they're not actually bearish, they're actually spreaders. They're not actually bearish, they're spreaders, okay? So they're basically gamma scalping the highs, and that means that we end up with this little word called sticky. It becomes a sticky top edge. It's not necessarily a slippy bottom edge, but it's certainly a sticky top edge. The price gets sticky in those areas as call sellers start to think that the market perhaps is topping out, the market's kind of finishing its upward move, and of course the life of the trade at that stage is pretty straightforward. Now, what about a positive gamma? Well, you might be saying, but that's interesting. I kind of understand that a little bit. But let's take a look at this positive gamma. Well, why do we get a positive gamma? Well, a lot of this, of course, is call buyers. And when do you get call buyers? Well, you get call buyers at lows, predominantly at lows, because obviously it's cheap, but it's also when people think the market is no longer going to be selling off, the people that sold their calls unwind short calls, right? It's people unwinding their short calls. Because if I've sold a call option at the top edge, because I don't think prices are going any higher, and the prices have collapsed, well, obviously that call option is now pretty much guaranteed that that premium is basically all mine, correct? If I've sold the call option, this premium is all mine. So what that mean? What does that mean? Well, of course, if I've sold the call option, I'm going to be able to buy up stock at the bottom edges, cheap equities, and possibly also speculative call buyers at low prices as well. I don't like the idea of speculative call buyers at low prices. Why? Well, for a very, very simple reason. They're going to be very expensive call options, aren't they, with the volatility, because we've reached a bottom edge. The volatility on the calls and the puts will probably be pretty reasonably high, right? So it's going to be a very expensive call option to buy into those. So I like the explanation more that it's not necessarily call buyers that are coming in, that it's more likely to be an unwind of the guys that sold their calls at the top edge, just closing off those positions, not thinking they're going to get any better out of their premium that they've collected for those call shorts, and simply using the money to buy more stock at lower edges. It's a perfect call rating strategy, of course, which, when you think about it, is a great way to make a living as a pension fund who can call rate all they like whilst holding on to the dividends of the long equities, but also being able to hedge out some of the downside by selling premiums when the price starts to become a little bit exposed, and then using those premiums to buy cheap stock when the price of stocks have fallen enough. They buy up a lot of cheap stocks with their options. It also helps to balance out their put option portfolio, allowing them to balance out against those, and obviously pick up some great gains from a long put option, for example, that they may bought as part of that strategy. Okay, let's move into the negative gamma coming from the puts. Why is this a double down line? This is a double down line because this is put buyers. It's put buyers. It's the big institutional trades that are now buying puts, usually on optics. And they're buying puts on optics because obviously this is what we would then refer to as perhaps some tail risk, right? We've got some tail risk coming onto the screens on optics, and therefore the big institutional traders are buying cheap puts to hedge any downside risk, and they may well be selling at the same time. They may well be selling some out of the money calls to try and accomplish something else with that idea, and that is that their downside risk is hedged without cost. And they've simply given away some of their upside on their stocks by simply selling some calls at the top edges as well. So they obviously can buy some out of the money puts. And obviously as they buy those out of the money puts, of course, what that brings is it brings hedge sellers. It brings in a lot of hedge sellers. So we would say delta hedgers selling on a downtick. Now, we all know that any time that we get a large amount of selling on a downtick, that's when the market can become incredibly slippy. And that's when we see big sell-offs happening, and that's that very slippy narrative that we're always aware of, always talking about at times, and we can understand that as a process. And finally, the puts that's got a positive outcome. What is that all about? Well, of course, the puts that have a positive outcome is a very, very simple storyline. Put sellers, and obviously put sellers are usually buyers unwinding. So a put seller is usually a buyer unwinding, and as the buyers unwind, of course, at lower prices, the puts have made a fortune, the closed out call options, and normally what we find is that we start to see these puts unwinding at lower edges, and obviously that unwind usually means that there is a very short position that the stock's holding for the delta hedgers that also has to unwind, and that becomes a buy in the stock market, and that gives us a very, very big buy side lift, and therefore the short hedgers are simply getting rid of their short hedges, their delta hedges, and buying into the stocks at lower prices, and the stock market takes a nice lift off of those edges, and that's why we get a positive outcome from that position. So there's the 4 scenarios. You might argue that this one has quite a sizable upside as well attached to it, but there is probably still some selling coming in. That's why we have 1 arrow. If you want to add a small buy arrow beside it, just to remind you that there is actually a fair amount of buy side response that can happen from this, then of course in that type of scenario there, we can start to recognize that this is the right thing to see. Now, obviously, when we see it, we understand these elements. We can start looking for that in terms of the deltas, the gammas, the VVIX, for example. As the VVIX sees this scenario here, bottom left, you would imagine the VVIX is getting murdered to the upside, of course, getting murdered to the upside of 1 over VVIX if you're looking at it from a short-sided trade. And obviously, the VVIX should be very, very crystal clear in the way that this is starting to evolve, as should the price of the SPY versus the VIX also be very, very clear as to how this graphic evolves over time. So a nice, easy to read idea about what happens on equities, and something to obviously pay attention to if you've got access to any of the information regarding deltas from any of the sources, Thinkorswim, for example, or the like. And from that information, we can start to get some ideas about where we are from these. Now, in terms of this morning's open, puts minus 20 million, calls plus 30 million. So puts minus 20 million, calls minus 30 million, giving us a net balance of almost 0. So nothing really too dramatic this morning on the S&P. The Qs, however, looks a little bit more positive. We've got a fairly reasonable upside on the puts and the calls. Predominantly positive put gamma. Predominantly positive put gamma. What does that mean? Positive put gamma. So there's the puts, there's the positive gamma. That means put sellers are unwinding their positions, put sellers. So we're starting to see this unwind of positions, and that's putting a bid into the equity markets. And we can see from that put positioning, you can see what's happened to equities at the start of the day. Equities have indeed managed to rally off of these areas based on that simple, easy to read delta graphic of $108 million. $108 million of upside gamma on the Qs against about a $10 million of upside gamma on the SPY. And yep, a nice upside pop on equities. Woo-woo! As if that's a surprise. Well, it's not a surprise, is it? No! Why is it not a surprise? Because the sentiment was positive ahead of the cash open, that's why. Take a look for yourself. The sentiment was positive. Guess what price we're at? 94. Who'd have thought that, Kim? 94 with my reputation. Look at it. 94 price. A level that we told you about was a key reference buy-side, sell-side level. The sentiment is positive. It's going up. The sentiment is positive. Look, we told you this already. We even drew these bloody red lines coming across this chart here as if we were making this shit up. We already told you about that. Into the narrative of the story here, you can see that this little phase here, see how we're starting to see the index arbitrage kind of selling coming in there. That's a buy, of course, on equities. And you can see that if we're selling the orange line, that means we're buying equities. And there's the buy into those areas there prior to this explosive move higher, which obviously is just exactly what happened right off the cash open there. 44.94s, just traded 0.6s. Another $500-600 of profit, guys. And pretty sensational stuff, pretty easy stuff to get your head round, I think, for anybody that's trading this this information. Very, very, very strong insight into what the hell is even going on, right? Very strong insight into what's going on, and a very, very easy money takeaway, considering we actually mentioned this whole phrase here about how bullish the sentiment had became at these higher prints. And the takeaway from that, absolutely fantastic. Look at what's happened on the exit of our trade. Everybody's poured in on the short side. Surprisingly enough, not really. Great stuff.